but it's locked. You cannot spend it. It's like putting it into a lockbox that is secured by the Bitcoin network. You get this ERC20 token, this Ethereum token, and then you can use that to take a loan. It's a synthetic representation of your Bitcoin on Ethereum, but you can use that to take the loan. And then when you burn that, you get the Bitcoin back. And this does scale because it only uses Bitcoin and Ethereum. You're not sending Bitcoin to us. We are not a chain. You maintain self-custody. And we believe this is the only technology that can actually scale.
Hi, Aki. Thanks for joining the show.
Thank you for having me.
Can you present yourself briefly and tell us about your Bitcoin-related activities?
Yeah, definitely. So quick introduction. I was born in Hungary, but I grew up in the US. I was a VC. I was a developer for over 30 years. I'm 39, so I started when I was a kid. I was a VC in 2011, looking at AI, big data, data management, marketing, automation. I left VC to start an AI marketing automation company, which I led for 8 years. I raised over $10 million, built the sales team, invented a technology. I have 2 patents to my name. And then 3 years ago, I came to Bitcoin and to crypto full time. And basically, the problem I wanted to solve is I have some Bitcoin miners. I was mining Bitcoin, every day. And I wanted to use it. I wanted to take loans on it in Aave. I wanted to use it for investing to earn a yield. And the Bitcoin was just sitting there. And so I started using WBTC and using it in Aave. And it just struck me that this did not seem to make any sense because I have the most decentralized asset in the world with Bitcoin, but then I have to send it to BitGo in one centralized location to then use it in a decentralized way in Aave. And I thought, well, could we just have a way to have Bitcoin directly be in Aave? And then that got me started on this path. And I learned about DLCs as a way to enable a decentralized wrapped Bitcoin. And I started DLC Link because I knew others will have this same concern as well. And now 2.5 years later, we are live. We have a decentralized wrapped Bitcoin called DLCBTC.
Okay, maybe for our audience that are not that expert as you are on the topic, I'm going to just break it down a little bit. So basically, if you're holding today any Bitcoins, you cannot lend them or earn yields on them unless you transform them into a wrapped BTC, where basically you send your Bitcoins to a centralized entity that sends you back another protocol token. Most of the case, it's Ethereum. And it's a wrapped Bitcoin that is exchangeable at any time with this centralized entity into your old Bitcoins. And then with this wrapped Bitcoin, you can use it on all types of decentralized platforms. And the idea behind what you're trying to do is to get rid of this centralized entity by wrapping or by bridging the gap between the Bitcoin blockchain and the other DeFi blockchains that are out there in a decentralized manner instead of having a centralized entity.
Yes.
Is it correct?
Yeah, that's absolutely correct. And the problem, the big picture is that there's over $1 trillion of Bitcoin, but it's not earning a yield. It's not a proof of stake system. You cannot stake it like you can with Ethereum. So it's just sitting there. And some of it has been lost. Maybe 20% of Bitcoin is lost, or in Satoshi's wallet, whatever. But 80% of $1 trillion is a lot of money. And so if you take $800 billion, if you could earn a 5% return, which is a very reasonable return on something like this, and maybe more, you can maybe earn more, but with more riskier bets. But let's say you can just earn 5% on $800 billion. It creates a lot of value. And it's an issue. And this is a software issue because the problem is you cannot use Bitcoin in Ethereum. And that's what we are solving, and these other wrapping providers are solving. And so then it's a question of safety. Like, what is the best design to bring Bitcoin to Ethereum? Because if in your design, If you use a central custody and something happens to it, the Bitcoin is gone. It's not worth it. It's not worth losing all your Bitcoin. So you don't want to put the Bitcoin at risk. And that's basically what Bitcoin bridging or wrapping solutions are all focused on, is what's the safest design to enable that.
Okay, and how do you address this technical problem, basically? How do you solve the bridge between the Bitcoin blockchain and the Ethereum blockchain in a decentralized manner?
Yeah, well, we looked at it and thought, well, okay, custodians are not the solution, because custodians blow up all the time. You look at FTX, Celsius, BlockFi; these are all custodied solutions. Voyager, yeah, like clearly that cannot be the answer, because let's say you have a great custodian, it amasses a lot of deposits. Let's say they have 100 billion in deposits. Something bad can happen, or the custodians also, they can screw up, or the legal frameworks around them. So for example, BitGo is a US company, so it is subject to the laws of the US. And the laws of the US are frankly quite challenging right now with the SEC and all of that. So the custody cannot scale. That is kind of the point of crypto, is you want to decentralize it. So then there have been another approach called bridging, where basically you send the Bitcoin to a bunch of servers. The problem is that is also too risky, because bridges are hacked almost every month. There have been some very large bridge hacks to the hundreds of millions of dollars. Axie had the Ronin bridge hack. There's a lot of them. And so bridges, if you take the decentralized Bitcoin and you send it to a bridge, and the bridge has 100 nodes or 1,000 nodes, whatever, you are not on the Bitcoin network anymore. You're on the bridge network, and you can lose all your Bitcoin if it's hacked. So bridges are also not going to scale. That was our conclusion. The only thing that can scale is if you do not send your Bitcoin anywhere. If you maintain self-custody of the Bitcoin and you keep it on the Bitcoin network, then that's the only safe method that actually uses the entire Bitcoin network. But how do you do that? And that's what we are basically a software company that has invented a way to do this. And what we call it self-wrapping. So basically, you use a mechanism in Bitcoin called a DLC, discrete log contract, but basically use this to lock the Bitcoin with yourself. So you keep the Bitcoin and you put it into a locked state where no one else can ever get the Bitcoin, but it's locked. You cannot spend it. It's like putting it into a lockbox that is secured by the Bitcoin network. And when you lock it, you get this ERC20 token, this Ethereum token, DLCBTC, and then you can use that to take a loan. It's a synthetic representation of your Bitcoin on Ethereum, but you can use that to take the loan. And then when you burn that, you get the Bitcoin back. And this does scale because it only uses Bitcoin and Ethereum. You're not sending Bitcoin to us. We are not a chain. You maintain self-custody. And we believe this is the only technology that can actually scale.
Okay, maybe it's a bit too technical for me, but how do you lock or you self-lock your Bitcoins? Is it like in the Bitcoin protocol, or it's a protocol that you have invented with which I have to interact with my self-custodied Bitcoins?
Yeah, it is in the Bitcoin protocol. So in the Bitcoin protocol, everybody knows you do not have smart contracts on Bitcoin, but you actually do have one type called the discrete log contract, which is not quite a smart contract, but it's like a very simple, like an if-then statement. And this invention, we did not invent this. This was invented 6 years ago at MIT by the creator of the Lightning Network, Taj Dryja. And before he invented the Lightning Network, he published a white paper on discrete log contracts with this goal of having like programmable logic on Bitcoin. And so it's very simple. It just uses the Schnorr signature, which was added to Bitcoin 2.5 years ago in Taproot. So DLCs have been possible for 2.5 years. And basically all that enables like an if-then mechanism. So if something, then bring the Bitcoin here, otherwise bring it there. In our self-wrapping system, there's only a then statement. So let's say Alice is the depositor, you are the depositor, you can move Bitcoin into a multi-sig that can only then pay out to you. and that conditional payment address is your wallet address, and that is enforced through this if-then statement of the DLC. But that's basically it. So we have used our software to implement this DLC feature, which already exists in Bitcoin, and that's why basically we're not a bridge. I call it a theft-proof bridge, but it's
Okay,
not a bridge.
but then how do you interact with the Ethereum network?
Yes, so that's a great question. So that's what we provide. Actually, we provide a set of relay nodes. So we provide a set of, there are node operators. It's not us, but it's companies like HashKey Cloud, Everstake, OKX. It's like large node operators. And what they do is they run a Bitcoin node and an Ethereum node, and they are just looking for signals, like on the Bitcoin side, did you fund that UTXO? Did you send the Bitcoin into the multisig? Once the Bitcoin network processes that, 6 Bitcoin block confirmations takes about 1 hour. Then they can see it on chain. Yep, it's funded. And then on Ethereum, they can see, so basically what they do is each of them have a Bitcoin private key they use to sign a message called an attestation. And so basically they are attesting to, yep, I see that Bitcoin is there. I attest to it with my private key. They cannot receive funds, so you cannot send Bitcoin to these attesters, but they are just like passing the message. And we have 15 of them, and once 10 of them have published the attestation, then the DLCBTC is minted. And then anyone can confirm this attestation, actually. So around that, we have Chainlink proof of reserve that also does a third-party verification. Yep, the Bitcoin is there. And so in this way, you're just basically publishing messages. You're relaying a signal from Bitcoin to ETH.
Okay, and how do you seize my self-wrapped Bitcoins if I take a risky bet on Aave and I lose my Bitcoins because I lent them to a certain protocol, and I ended up losing my yield, and therefore you have to enforce from my private address the seizure of my Bitcoins. How do you do that?
Yeah, that is absolutely correct. If you are the only one that can redeem, then who is the depositor? And we realize it is not retail, it's banks, it's financial institutions. And specifically, they're not just banks, but it's OTC desks, market makers, prop trading desks. These are financial institutions. And then we realize basically it's USDC for Bitcoin is what we have. We have a series of financial institutions that can lock Bitcoin with themselves to mint the DLCBTC, which they can make money trading. And this is actually something called the merchant system. So WBTC and USDC also have merchant systems. They, like, retail cannot mint. You cannot send dollars to Circle to get USDC. Retail can only swap. But these institutions, these merchants, are the ones that put up Bitcoin, and they have an incentive to do so. So they can make money. They can make trading fees essentially, and yields by locking their Bitcoin, which otherwise their Bitcoin would not be usable, right? So they can lock it and they can use it to make money. And then when you want to redeem, you actually have to pay them to redeem. So let me be a little more clear. So let's say you and I are both retail users, and let's say Amber Group, which is our first merchant, Amber Group is the merchant behind it. If I want to acquire DLCBTC, because I cannot mint, I have to swap for it, and I pay Amber. If I do an OTC, I pay Amber the OTC fee, and then I get the DLCBTC. Then I can take a loan on it or earn a yield. Obviously, I make a higher yield than the fees incurred, so that's why my profit incentive. And then when I want to go back out the Bitcoin, I also pay the merchant to swap back, and that's the merchant system.
But isn't it going back to the original problem that you have is the decentralized nature? So in this case, Amber is the central authority instead of BitGo for the wrapped BTC. Why is it different?
That is correct. It's only different in one way. The custody is decentralized. So in the WBTC system, they have 70 merchants, and all the 70 send their Bitcoin to BitGo, and BitGo puts it in their vault, puts it in one place. And then the 70 all rely on BitGo to get the Bitcoin back. In our system, let's say when we have Amber, we only have one place, but when we have multiple merchants, which we are now up to 5 merchants. So now we have 5 merchants, each of them maintains self-custody. So if Amber goes bankrupt, the other 4 merchants still have their Bitcoin. They're not reliant on a central point of failure.
Okay, I got it. I got it. Interesting. Okay, I'm going to challenge you a little bit on your business model. There is a famous phrase in the Bitcoin community that says, where does the yield come from?
Yes.
So you're mentioning about 5% as if it was an easy task to generate yields on your Bitcoin. I find it like one of the hardest things because you're already holding one of the best performing assets, past and future, and generating additional yield on it. It means some risk taking that you're gonna take on top of the risk of holding Bitcoin. So where do you get the 5% from?
Yeah, and this is the problem that you are mentioning is also like a practical problem of Bitcoin. Is if I want to take a loan, but I want to do Bitcoin only stuff, then I have to use CeFi. I have to send it to Anchorage or BitGo or whatever. It's all CeFi. But if I don't feel that CeFi is safe, I want to do DeFi. Can you have DeFi and Bitcoin? Not really. Really, where does DeFi live? In Ethereum and other chains like Solana, but mostly Ethereum. And where does it live? In Aave, in stable coins, in options protocols, in staking protocols. Now you have LRT, liquid restaking protocols. And basically, this is where we plug the DLCBTC into. So you can take a loan on Aave, take a loan in Ethereum, stake the Ethereum, or take a loan in a stable coin and invest with the stable coin. Or you can do, now you have staking. So you cannot stake the Bitcoin. I don't believe Bitcoin staking exists, but Bitcoin restaking. So you can take the DLCBTC and use it to secure a proof of stake system. There's a lot of LRT protocols like Karak, Swell, Nectar. There's a bunch of these that do this, and they take the ERC20, and then you earn yields by securing the network. And if you're slashed, you lose the collateral. So that's another common one. Options is another one. Another common strategy is to do covered calls on Bitcoin while you're holding it. So you can do DeFi options platforms. So these are all like financial strategies, and you can pick, which protocol you like in the Ethereum system.
Okay, I see. There's been like with the arrival of runes, a lot of talks about all these decentralized DeFi platforms and protocols moving to the Bitcoin layer 2s and layer 3s, and that DeFi will become built in on Bitcoin. If this moves happen, doesn't it jeopardizes your business model as a whole?
So we can wrap.
I mean, what do you think about the move, and what do you think if it happens?
Yes, yeah. I guess I'll give you two layers of answer. We're very excited about people building on Bitcoin. We are building on Bitcoin in a really simple way. So this very simple. I mean, we are only using one feature of the DLC mechanism. It's like the simplest thing you can do. There's more things that can be done even with DLCs. And then outside of that, we're excited for BitVM, runes, ordinals, everything. So we're really excited that engineers, are making Bitcoin stronger, better, be able to do more things. When those chains arrive, because right now you don't have L2s on Bitcoin, you have side chains that are like, they're called L2s, they're Bitcoin L2s, but they're not actually roll-ups, and that's like, they all openly advertise this. So right now, that's the state. So right now, we are wrapping to the chains that have DeFi activity, like EVM chains, Solana, Cosmos, let's say Injective, Polkadot. If maybe Polkadot might be a bad example now because they're sort of struggling, but any chain where there's DeFi, we can wrap the DLCBTC2 very easily. because we don't actually all that our node operators have to do is they just have to run a node of the chain and they can publish attestations of the chain. Very easy. We can be up in a few hours. When these Bitcoin L2 layers arrive and get bigger, and there are some already that are quite successful, like BitLayer and things like that, then we can wrap DLCBTC to BitLayer or BEVM or B squared or any of these. The difference there is in order to mint on these Bitcoin L2s, you have to bridge. Stacks is another one. You have to bridge your Bitcoin into the chain. If you are if you're a financial institution like Amber or Galaxy or whatever, you probably do not want to bridge your Bitcoin into a Bitcoin L2 because the bridge is very dangerous. I mean, every bridge is dangerous. So what you can do instead is become a DLCBTC merchant and self-wrap your Bitcoin to DLCBTC on BitLayer. Then it's a wrap representation on BitLayer, and then you can do the BitLayer DeFi stuff, take it from there.
Okay. And perhaps one question about your business model in terms of how you operate a company based on a very volatile underlying. How, compared to what you have been doing in the past 30 years, as you explained, how as a CEO you manage all this volatility and all this ups and downs in the Bitcoin/crypto communities?
I guess maybe the first answer I should say, as someone who emigrated to the US with my family in 1991, we're used to volatility. It was quite a challenge coming to this country and like building out our life here and learning from my parents to learn the language, us too. Like there's a little bit of chaos there. Also coming from Hungary, which is, I would argue, is a chaotic country already by itself. And then being doing the last startup and kind of AI and all that in 2013. It was early days for all of that too. But specifically, it really comes down to, for us, treasury management. So we take our fees in Bitcoin, just like WBTC. We take mint and burn fees. Our fees are lower than WBTC because we have a lower cost basis. WBTC, Bitco, they have to have the vault fees, the overhead, the deposit insurance that does not cover all your deposits, but it covers some of the deposits. They have to pay the premiums on that. They have all these costs. We do not have the cost because we're not a custodian. We never get anyone's Bitcoin in custody. We're not a money transmitter. We're not a regulated entity. We're not a VASP. We're just a software company that lets you lock your Bitcoin with yourself. So we don't touch your Bitcoin. But that also means our costs are lower. So our mint and burn fees are 25% lower than WBTC for mint and burn, which means that our merchants make more money doing the same activity, which is attractive for them. And then we get paid in Bitcoin. And so just as any kind of private company, we raise funds in dollars to finance the activities, to build the business model. But at some point, we will be cash flow positive, and then we will be making more Bitcoin, and then we will sell some of the Bitcoin, or we will put the Bitcoin into DLCBTC and earn the yield ourselves, over the long term.
Okay, and I don't know if it's public or not. Did you raise any capital? Are you in the capital raising mode? What kind of information can you publicly disclose?
Oh, sure. Yeah, it's pretty much all public. We have done 2 rounds. The investors are also listed on our blog, but there are about 25 investors that participated in we had a pre-seed round, and a strategic kind of a pre-seed prime round. And then now we are doing a seed round. But the previous investors were, OKX, ABCDE, Chainlink was a first investor through a grant, not an equity investment, but a grant. Leading a couple of Bitcoin whales. So we have about 24 site ventures, Animoca, a bunch of these DeFi ones, some Bitcoin funds. And then now we are raising.
And how much did you raise on the first round?
Yeah, we raised 3 million total. And the last valuation was 25 million post money. that was last year when before we had the product. Now we are launched, we're live, we're on mainnet, on Arbitrum, on Ethereum, on some other chains, Base coming up next. And so now we are raising a seed round. We are raising 5 million on a 70 million post-money valuation. It's a safe, the instrument is a safe note with a token warrant, and we will launch a token targeting November. And the token is actually just to help decentralize these attestors, because there is one, we are not a trustless protocol. There's one thing you have to, there's one risk. The Bitcoin cannot be stolen. Even if the attestors are hacked, the Bitcoin cannot be stolen. But if the attestors collude or if they are hacked, you need a 10 or 15 threshold. So if 10 of the attestors collude, they can ransom attack you. So they cannot steal the Bitcoin, but they can censor your unlock. So when you let's say Amber Group has minted DLC BTC, now they burn it, but the attestors refuse to publish the burn attestation, and then you have to pay them a bribe or a ransom to get your Bitcoin back. In order to eliminate that or to reduce the risk of that, we are basically launching a token that they stake and they get slashed in and so on.
Okay, very interesting. I think I asked you all the questions that I have. Do you have any other things you want to share with us from your Bitcoin experience and your Bitcoin business building, I would say?
Yeah, I mean, I cannot claim to be a longtime Bitcoin OG. I heard about it in 2011. I did not focus on it then, so I missed out on a lot of the pump. No problem. Next best time is now. But we do use. So there are some companies that are, frankly, much better Bitcoin developers than me. One that I have to mention was Assured Bits. So basically, to step back, so 6 years ago, when the first white paper, when the white paper about DLCs were published, that was like a math. It just shows the math. It does not show the application. And a company called Assured Bits picked it up and worked on DLCs for several years. They built the DLC community, DLC specification. They did a lot of work, but then they went out of business because they could not figure out a business model. So we actually hired one of their co-founder, their CTO, as our technical advisor, Nadav, and then we kind of stepped in to help build the DLC community. But basically, all that to say that there's a DLC community. It's quite small. There's about 300 DLC developers. I think there's a lot more possible with DLCs, is what I'm trying to say. I think what we have built with DLC BTC is like a very small piece of the puzzle, and I think there will be a lot more development. So I really, although I am not a Bitcoin OG, but I always encourage Bitcoin, folks looking at Bitcoin and DeFi to look up DLCs, learn about them, see what they can do, participate in the community, because I think that this bridge problem is not going to go away. I know a lot of people have made a lot of money with Merlin chain and whatever. There's like a lot of new chains, but they are all bridging Bitcoin, and I think they are forgetting the number one thing, which is not your keys, not your Bitcoin. And I think there's a lot of venture backing and PR around the bridging, but there's not enough conversation about, wait a moment, you're sending your Bitcoin to the servers of Merlin chain. How safe is that? So my biggest goal, other than making DLCBTC a commercial success, which I believe it will, but my other bigger goal is just to talk about safety when it comes to bringing Bitcoin to other ecosystems.
Okay, I hope this idea will inspire more people to build on DLC and bring more to the Bitcoin ecosystem. Thanks a lot for sharing all these insights with us, Aki, and I was really happy to have you on the show.
Thank you for the opportunity, Jed. It's a pleasure.